Are you interested in finding out the next great stock to invest in? Are you looking for a stock that will double your money in a year or less? Well, in this video, I'm going to talk about a company in Singapore that has one of the fastest growing shopping websites, payment platforms, as well as a gaming development and publishing business. See if you think it will be the next big thing. Stay tuned to find out more. Hello and welcome. I'm Wayne from WES Investments, bringing you stock market news, portfolio updates, and training on how to make money in the market, all on this channel. So if you're new here, consider subscribing and hit the bell so you're notified of my latest videos. Now the boring bits first. I'm not a financial professional. This is not financial advice. Please don't take financial advice from somebody on YouTube. And finally, do your own research. Do not make any decision based purely on this video. So I've had a few people mention to me the company SEA, spelled S-E-A or ticker S-E, and that I should take a look at it and see if it's worth investing in. The first and the main thing that they tell me is normally about the website Shopee and how it's taken over Alibaba's Lazada as the top website in Southeast Asia. Its share price is already up 400% over the past 12 months, which is phenomenal. So obviously this has piqued my interest. A growing e-commerce company coming out of Singapore seems very interesting, especially with the level of growth in the share price. Then I looked at the company further. They also have a payment solution which is much like Alipay, and a game developer that has some really great names under its management. Games like League of Legends, which even I've heard of, as well as Free Fire, which was the most downloaded mobile game globally. So I guess many of you might be saying, just shut up and take my money, right? Well, let's see. So what I'm going to do is I'm going to take you through my whole thought process for investing, let you see the kind of things that I see as important and see what kind of things get me excited about stock. Right, so first of all, if we look at the financials, what would you expect to see from a company like this? It's fairly new, so I'd expect to see a company that has not started to make a profit yet. Probably won't for a couple of years. We would expect to see a rapidly growing revenue, probably a huge amount of debt, with probably a fairly low level of assets or cash. So having a look at it on eToro and at the financial summary screen, here it's a growing loss. It's not unexpected, fairly standard for a growing company like this. However, a bit of a warning sign for me is this level of loss compared to the overall revenue. To recover these losses, the company needs to grow its revenue very significantly. I mean, this net loss of 1.46 billion with a gross margin of 29.34% would mean to match this level of a loss, they would need an extra 5 billion in sales without growing their operating costs. It's not impossible, but that is a hard task. Revenue is growing very fast, and to make an extra 5 billion on top of the current 2 billion appears that it could be possible at its current growth rate in a couple of years, if it continues growing at the same or faster pace, as long as it doesn't increase its operating costs. And that's the main thing, because its margin on the business is one thing, its operating costs is a whole new area, and we'll talk about that shortly. Their balance sheet is quite surprising, and they appear to have a very good level of assets compared to liabilities with relation to what I was expecting. So although this is quite high, not really what we would want to see for the future, for a growing company, this is actually not that bad. So now that we've had a look at the eToro details and this quick summary screen, let's look at the company itself and how it shares its financial details with us. So after looking at the financial updates for the business on their website, we can see some really exciting numbers. I started to look through the infographics to start with, just to get the main ideas of what they wanted to tell us. And it's very clear that the business is growing so fast, money is pouring into the company. Little bit of a concern that they often are talking about the amount of underlying profit that the gaming sector is generating for them, but they never mention that about the retail sector. So let's have another look further into the company's financial reports and see what information we can get from that completely. So reading the full report, it appears that money is pouring out of the company faster than it comes in. The e-commerce platform appears to be the main drain for this, with the digital financial services also being quite expensive for the company. I think that what concerns me about these two elements of the business is at what point do these parts become profitable? They already have the biggest e-commerce platform in the region that it's involved in. And the e-commerce world is growing very fast, so I have no doubt that their sales will continue to grow. My concern with this part of the business is how much it's going to grow. Because it looks to me like without further expansion into new regions, for this part of the business to become profitable, the e-commerce market for the countries that it currently is in would need to grow by around 300%. That means that for every $1 spent online today, we would need it to grow to $4. And this is without increasing any costs. And maybe this growth is possible. And maybe Shopee still has significant market share it can take from the other companies in these regions as well. So let's move over to the jewel in the crown of the company, which is the digital entertainment. This is the part of the company that, at least on paper, actually seems to be making money and is doing very well for the business. Now, I say it like that because I'm not confident with the way that they are doing their accounts, exactly where all the costs are attributed. So, for example, the digital entertainment segment made a profit of around $450 million in Q2. But that was before sales, marketing, research, development, and general business expenses. All these costs are attributed to the business as a whole. So we don't know what proportion of these costs are caused by the entertainment segment. And when you're talking about over $1 billion of costs in just the second quarter of the year, compared to a segment that's only made $500 million in that same time, it doesn't take much to think that either the other elements of the business are really burning through cash, or actually the entertainment segment is not quite as profitable as it seems. Now, again, profitability is not actually a problem with a growing business, because a business can grow into profitability. So let's look a bit more at the entertainment segment and see what they actually have. So from my understanding, they have the distribution rights for their market area for a number of online games, including the likes of League of Legends. This is a great idea because it means the company can gather plenty of data and experience with existing hit games while simultaneously working on growing their own games. This should mean much higher chance of success with their games and lower costs involved as well. And this absolutely seems to be what we're seeing with the launch of the first game, which is Free Fire. This game is one that they've created in-house. They have also purchased a Canadian games developer, so they are really staking their flag in the international games market, which is a great sign for revenue and profitability for this company. So let's talk about the actual share price. And to do this, I'm just going to compare Alibaba, because in my opinion, and it's a similar type of company, its current share price compared to the profitability of the business is that it will take around 40 years at the current profit to cover the share price, which for a growing business is a reasonable level. The reason this is important is because for C to be a viable option at its current price, what we need is to be able to see the company make a level of profit that would be on par with 40-year level, and then that will surpass it as well. I'm not quite sure if that's made a lot of sense, so I'm going to put it another way and include a little bit of graphics here, and it might help. So, with Alibaba, what people are saying is they believe in the future the company will grow to the stage where it will earn considerably more profits than it does now. But let's say the share price stopped growing from today's date. So if it hit that wall and it didn't move, that would indicate that what people are expecting to happen is that next year it would double its profits so that it stayed at the same price. It would then be 20 times its earnings. Double the following year and it would then be at 10 times its earnings, then it would stop growing. And so the business would make that level of profit consistently then for the future onwards, and that would maintain its share price. Now, obviously that would never actually happen, but this is kind of how the price is set. What would actually happen is that next year, if the business grew to that level, it would then likely double in value because it would be anticipating this growth to continue for another few years. And obviously that's not that it will suddenly jump in value, it would build up to that level because that's what people would be expecting. Let's take this over to C and see what we can see. C. Its current market cap is around 75 billion. To reach the profit to justify this market value, it would need to make a profit of 1.875 billion with the expectation of making 7.5 billion in profit over the following few years. Now, maybe this is completely possible. Maybe they will continue to grow their market base, bring out more and more hit games, expand the e-commerce site and move into other countries, or even just turn the current platform profitable within their home markets. I don't live in the markets that this company operates in, or play the games it hosts or creates, or use their payment services. This means I don't know how much more growth this company has. While I am sure that there is considerable room for growth, I just don't know if it's enough, because for me to invest in this company, I would need it to be expecting a market cap of 150 billion, which would ultimately mean a profit for this company of 15 billion. And I'm just not quite sure that they're going to see that level. So what do you think? Am I wrong? Am I missing important information? Let me know in the comments below. I'd really love to hear what you think. Thanks for watching. I hope you're going to give me a thumbs up in the video, and I'll see you in my next one.